Most agencies track revenue and call it a day. Revenue tells you what already happened, it doesn't tell you why, and it doesn't tell you what to fix. This training covers the performance metrics that actually predict where your agency is headed and how to track them without drowning your team in dashboards. We're going to walk through the core metrics every independent agency owner should be measuring on producers, on the book of business, and on the sales process itself. By the end, you'll have a short list you can put in front of your team this week. Here's the trap most agency owners fall into. You hire a producer, you give them a goal, and the only number you look at is whether they hit it or missed it. Hit or miss is the worst possible feedback loop, because by the time you know the answer, the quarter is already gone. Performance metrics solve that. They give you leading indicators, they tell you weeks in advance whether someone is on track or quietly drifting, and they tell you exactly which lever to pull to fix it. Activity is down, quote to bind is down, cross-sell ratio is flat. Each of those points to a different conversation and a different coaching plan. The other thing metrics do is take the emotion out of management. When you sit down with a producer and the numbers are on the table, you're not arguing about whether they're working hard enough. You're looking at the same scoreboard together and figuring out the next move. That's a completely different conversation than the one most owners are having. There are roughly a dozen metrics agency owners chase, and most of them are noise. I'm going to give you the short list. 5 categories. Inside each category, 1 or 2 numbers that actually move the business. Category 1 is activity metrics. These are the inputs: calls made, appointments set, presentations given, applications written. Activity is the only metric your producer fully controls. They can't control whether a lead closes. They can control whether they pick up the phone. The 2 activity numbers I track every single week are appointments set and presentations given. Appointments set tells me whether prospecting is happening. Presentations given tells me whether those appointments are turning into real sales conversations or whether they're getting talked out of the room. If presentations are flat but appointments are up, you have a confidence problem. If appointments are flat, you have a prospecting problem. 2 numbers, 2 different coaching paths. A general benchmark for a full-time Medicare or final expense producer is somewhere between 15 and 25 appointments per week and 10 to 15 real presentations. Adjust for your market and your lead flow, but if a producer is sitting at 5 appointments and 3 presentations, you don't have a sales problem. You have an activity problem, and no script in the world is going to fix it. Category 2 is conversion metrics. This is where activity turns into revenue. The headline number here is quote to bind rate, sometimes called close rate or application rate. Out of every 10 qualified prospects who get a real presentation, how many actually enroll? For a seasoned Medicare producer working warm leads, a healthy quote to bind sits around 40 to 50%. For final expense, it can run higher because the sales cycle is shorter. For ACA and under 65 health, it varies wildly by market. The number itself matters less than the trend. If your producer was closing 45% last quarter and they're at 28 this quarter, something changed, and you need to find it before the quarter ends, not after. The second conversion metric I watch is lead to appointment rate. How many of the leads you paid for actually turn into a sit-down? If your team is buying leads at $30 a piece and only 1 in 10 becomes an appointment, your real cost per appointment is $300. That number changes everything about what your producers are allowed to walk away from. Category 3 is production metrics. This is the output: written premium, applications submitted, and policies issued. Most owners track written premium and stop there, but written premium without context is misleading. A producer who writes $300,000 in premium across 40 policies is in a very different business than one who writes $300,000 across 12 policies. The first agent has a deeper book and more cross-sell opportunity. The second is one big account away from a rough quarter. Track 2 production numbers together instead: total written premium and policies per producer. Together, they tell you whether the book is being built or resting on a few big accounts. The third production number is policies per client, your cross-sell ratio. A client with 1 policy will leave. A client with 2 stays significantly longer. A client with 3 is almost permanent. Multi-line household data consistently shows retention climbing with each added policy. which is why this single ratio drives more long-term agency value than almost any other number on the dashboard. Category 4 is retention metrics. This is the metric most new agency owners ignore until it's too late. Persistency rate measures how many of your policies are still in force after 12 months. Retention rate measures how many of your clients renew year over year. For Medicare Advantage, healthy persistency runs around 85 to 90% in year 1. Below 80 and you have a problem. Below 70 and you have a fire. Low persistency means clients are leaving for other plans, switching agents, or canceling because they were sold the wrong plan. Persistency matters so much because renewal commission is where the real money lives. The first-year commission gets you in the door. Renewals build the business. A producer with strong year-one production and weak persistency is renting their income. A producer with steady production and high persistency is building an asset. As the owner, you want to know which one you're paying. Category 5 is efficiency. 2 numbers here: cost per acquisition and revenue per producer. Cost per acquisition is the total marketing and lead spend divided by the number of new clients acquired. If you're spending $10,000 a month on leads and bringing in 20 new clients, your cost per acquisition is $500. Compare that to the lifetime value of a Medicare client, which sits in the thousands across the renewal stream, and you can see immediately whether your marketing math works. Revenue per producer is the simpler one. Total agency revenue divided by the number of producing agents. This tells you whether you're scaling efficiently or just adding headcount. If revenue per producer is climbing, your systems and training are working. If it's flat or declining as you hire, you're growing in name only. Let's walk through this in practice. You're sitting down for a Monday review with a producer. Pull up 6 numbers. Appointments set last week. Presentations given. Quote to bind percentage for the month. Written premium for the quarter. Policies per client. And persistency on policies they wrote 12 months ago. That's it. 6 numbers. Now look at them together. If appointments are at 20, presentations at 12, close rate at 40%, and persistency at 88%, you have a producer who is healthy across the board. Your job is to keep them out of their own way and start having scaling conversations. New territory, bigger campaigns, mentoring a junior producer. If appointments are at 20 but presentations are only at 6, the producer is getting in front of people but losing them in the first 10 minutes. That's a discovery and qualification problem. Coaching plan is role play on the opening conversation. If presentations are healthy but close rate dropped from 45 to 28, something changed in the close. Maybe a new product is confusing them. Maybe a competitor moved into the market. Maybe they're tired. The number tells you to ask the question, but the conversation is where the answer lives. 2 mistakes to avoid. First, don't track 20 metrics. Track 6. Agencies that build dashboards with 30 numbers, stop looking at any of them within a month. Agencies that pick 6 and review them every Monday actually run their business with data. Second, don't use metrics as a weapon. They're a coaching tool. The minute you turn the Monday review into public shaming, producers start gaming the numbers and hiding the truth from you. The whole point of leading indicators is they tell you the truth early. If the culture punishes the truth, you've broken your own system. Here's your action step. Today, before you do anything else, pick the 6 metrics you're going to track for every producer on your team. Use the categories we just walked through. 1 activity number, 1 conversion number, 2 production numbers, 1 retention number, 1 efficiency number. Write them down. Build the simplest possible spreadsheet or dashboard to capture them weekly. Then put a recurring 30-minute Monday review on the calendar with each producer. You don't need a fancy platform. You need a habit. The agencies that win the next 5 years know their numbers cold and have the conversations the numbers point them toward.